Well, between the trade war, growing recession fears here, unrest in Hong Kong, and increased concern about the fate of Brexit and some of Europe's biggest banks, $15+ trillion in country debt is now yielding negative. So what is all of this telling us, and what should you be doing with your money right now? Joining us now is Kathy Jones, Chief Fixed Income Strategist at Charles Schwab, and Jim Cielinski. He is Global Head of Fixed Income at Janus, Henderson, joining us from London. Kathy and Jim, a real pleasure to have you on at this important time. Kathy, you've got a 10-year bond yield, which can't get out of its own way here, still yielding 1.69%. Is the bond market, to you, saying that we're going into recession soon, or is it more of a reflection of all the negative yield around the world and the fact that we're one of the few nations still offering any kind of a return to investors?
Yeah, I think, Brian, it's really the latter. We do have a slowdown going on in the U.S. and certainly a reflection of the slowdown in the global economy and a lot of worries about the trade war. But I think absent the global pressure, U.S. rates probably would be higher. And I think that there's a real cap on U.S. interest rates because there's really very few other places to go to get a positive return. And so we're getting a lot of capital going into the U.S. Treasury market and U.S. markets in general, seeking some sort of a positive yield.
Yeah, and if we go, so the 2 and 10-year spread, I know it's a little bit wonky, is about 0.1%. So call it, 1/10 of 1% is the difference between the 2 and the 10. If we do, Kathy, get that inversion, if the 2-year yield goes above the 10-year yield, does that automatically signal to you that there is a recession, or again, maybe more of technical moves and other factors in the bond market? Because it looks like that's where we're headed.
Yeah, so the 3-month 10-year has been inverted on and off since May already, and now the 2-year 10-year is getting pretty close to inversion and has been a reliable indicator of recession in about 12 months ahead. But not every, there have been a few false signals along the way. I would say the bigger concern for me is just the slowdown in growth that we're seeing taking place globally and the spillover to the U.S. So the 2-year, 10-year can be a symptom rather than a cause of recession.
Jim, what's amazing is that I think that if we didn't have the trade war and now the Hong Kong protests, the sort of sickness of the European bank stocks and fear over the European banking system might be our top story. How concerned are you when you look at especially the charts of a Deutsche Bank or a Commerzbank?
I think the concern for me extends to Europe more broadly. I look at Europe as having more endemic problems than we realize. Not only do you have the banking issues, I think the ECB toolkit is laid bare, and anything they do is likely to only worsen net interest margin. So I think the banking industry is in trouble for a bank-centric economy, but equally demographics are poor. The Italy situation has flared up once again, and you have an industrial recession for an export-driven economy. And I think the odds that are now stacked up against the Eurozone are quite significant. And I do think if it wasn't for the China headlines, the trade headlines, we'd be heavily focused on, what is the end game for the Eurozone?
And are the banking problems and the banking headlines, are they simply endemic to the banks, Jim, or are they representative of larger problems that the bond market is flashing a big red flag for global investors?
I think it's a little bit of both. I think the banks in Europe are unique in that their profitability has suffered, but also the negative yields, I think, are here to stay. And then a lot of bad decisions on top of that. But I think the growth in the Eurozone, and particularly in the SMEs and the types of enterprises that banks have lended to, there's just no demand. So there simply is not an easy way out for banks to see a profitable outcome to this. So I think it's a very broad-based issue.
Kathy, are there any reasons for our viewers out there who've been aggressive? Maybe they've been 90 or 100% equities for the last number of years and it's paid off. Should they own U.S. government 10 years at 1.7%?
Well, the primary reason to own them is that they're a great hedge against weakness in the equity market. So when you look at assets that are negatively correlated with the equity market, U.S. Treasuries, particularly those with some longer duration, tend to do best when the equity market goes down. And I would add that Treasury's actually done very well this year too. You've got double-digit returns in long-term Treasuries, so it hasn't been that bad an investment so far this year. Now, I would not advocate everybody run out and buy long-term bonds at this stage of the game, but having some intermediate term Treasuries in the portfolio as a way to hedge against market volatility is still a good idea, even at these low yields.